Welcome back to the Kairos. Investing might be getting harder, echoing the era of the 1970s oil shock. Following the recent escalations between Israel and Iran, the difficulty of navigating the markets is likely to increase. But remember, a tougher market environment does not inherently mean lower returns. In fact, extreme volatility can serve as an opportunity to amplify your yields in the context of new Cold War investing. First and foremost, we must identify which historical period mirrors our current reality. Aligning past macroeconomic cycles with the present is one of the most effective approaches to decoding the structural changes underway in global capital markets. Today's focal points are clear: interest rates, inflation, oil, gold, national security, and broad commodities in the energy transition era. Think about it. Post-COVID-19 inflation, combined with rising rates. What happens if a sudden oil spike is added to the mix? Does history repeat itself? While it's difficult to label the current environment a pure oil shock, we must remain hyper-vigilant regarding the escalating Middle East tensions centered around Iran. Let's examine the present through this historical lens. The true origin of the 1970s shock must be traced back to the Nixon Shock prior to the oil crisis. In August 1971, the abolition of the gold standard, the collapse of the Bretton Woods system, marked the beginning of a highly volatile era for asset markets. Then came the first oil shock in October 1973, triggered by the Yom Kippur War. From that point on, entrenched high inflation and high interest rates dominated the landscape until the early 1980s. Let's look at the historical parallels. In 1971, currency devaluation and the end of the gold standard. In 1973, the oil shock, driven by energy and geopolitical risks. Fast forward to 2020, the COVID-19 pandemic and massive liquidity injections, and from 2022 to the present, the Russia-Ukraine war and escalating Middle East conflicts. This undeniable resemblance draws our attention to the sectors that demonstrated secular strength from the mid-1970s to the early 1980s. The collapse of the premium growth stocks, the Nifty 50, gave way to a massive rally in energy and commodity-related equities. So what are today's blue chips? Following the historical oil shock, real asset equities surged due to inflation, while value and cash-generating blue-chip stocks showed relative resilience amid high interest rates. Conversely, sectors with high debt ratios or poor cash flows suffered devastating losses. Today, the major big tech firms driving the AI revolution have secured massive profitability. This allows investors to treat them as cash-generating blue chips, rather than speculative growth assets. Furthermore, in this climate of elevated geopolitical risk, the defense sector maintains a powerful, secular appeal, and we must look at AI and energy infrastructure as national security. To sustain and scale AI capabilities, immense data center power demands and grid management are required. Because AI is fundamentally a national strategic industry, the infrastructure that powers it must be viewed through a national security lens. Simply put, without electricity, there is no AI industry. Looking ahead, US President Donald Trump may declare victory regarding current conflicts and attempt to expedite an end-of-war declaration. However, regional uncertainty has only deepened, with expectations that the Strait of Hormuz may face blockades by the IRGC. Are we witnessing a revival of the profound uncertainties that followed the 1973 Middle East War and the 1979 Iranian Revolution? As we review today's investment landscape, we do so with the anticipation that resilient investors will once again shine through, identifying the right opportunities amidst the storm. Thank you for watching the Kairos. If you found this analysis helpful, please like, subscribe, and share your thoughts in the comments below.